Industrial manufacturing patterns are shifting. After several quarters of depleting buffer stocks, customer orders now align with actual production schedules rather than inventory drawdowns. This recovery is being reinforced by the data center segment. While Microchip does not produce AI GPUs, it manufactures the specialized power management ICs and PCIe Gen 5 switches required to regulate high-density server racks. These components position the company to transition from a traditional industrial cycle into the specialized supply chain for AI infrastructure. This chart compares fiscal Q4 2026 revenue against analyst expectations. The $1.28 billion result exceeded the $1.26 billion consensus, marking the company's return to sequential growth. Management stated during the earnings call that the inventory correction is nearing its end. Because customer stockpiles have been exhausted, new revenue is now driven by direct manufacturing demand in automotive and robotics. The company maintains a moat through its proprietary mixed-signal microcontrollers, which represent 50% of total sales. These are sold alongside a dedicated analog power management portfolio. This diagram contrasts Microchip's capital strategy with peers like Texas Instruments. While competitors are spending on the construction of 300mm fabrication plants, Microchip has shifted 67% of assembly in-house to prioritize internal optimization. By utilizing this lean manufacturing model, the company aims to capture rising power requirements in the data center while generating free cash flow rather than increasing capital expenditure. Investors are currently paying a premium for this operational efficiency. The stock trades at a PE ratio of 366x and a price-to-sales multiple of 9.3x. To sustain this valuation, the company relies on its defensive balance sheet. Net leverage has been reduced to 1.2 times, a level management describes as healthy for the current interest rate environment. This chart outlines the $5.5 billion long-term debt schedule over 5 years. Near-term liquidity is supported by a staggered schedule. Only 7%, $387 million, is due within 12 months, with the largest concentration of $1.9 billion not maturing until year 4. However, the 10-K filing identifies specific macro risks, including reliance on federal CHIPS Act incentives and potential exposure to new executive branch tariff policies that could impact international trade. While the debt wall provides a multi-year cushion, the current valuation leaves little room for delays in the expected data center recovery. This chart summarizes the current analyst outlook. Of the 25 analysts, 19 maintain a buy rating, 6 recommend a hold, and 0 sell. The consensus price target is $118.50, suggesting analysts expect further appreciation as revenue recovery continues. With the industrial inventory cycle finally normalizing, Microchip's performance is now tied to its ability to capture high-margin design wins within the AI hardware infrastructure.